Our next talk is going to be a panel conversation really about going beyond startups. It's going to be moderated by Bob Hedges, as a partner with A.T. Kearney. I don't know if any of you saw today's Wall Street Journal article about the investigation of Wells Fargo and explaining how something simple can become something so complicated. I invite you to read it, but hats off to A.T. Kearney, the consulting firm, and Bob's efforts there as the head of the financial services. Before that, he's had an extensive experience in consulting. Before that, being in the financial industry with Shawmut Bank, Fleet Boston, and Fidelity Investments. And with no further ado, let's go for the panel.
I can follow you, but we'll try my best.
All right. Okay. Thank you, Armin. We're all pleased to be here today, and I'll start by introducing the esteemed group of panelists that have joined me up on stage. We're the last act, but hopefully we'll be maybe at least a third as exciting as the one that preceded us. But we've been charged with talking about beyond the startup, and what we're really going to talk about, is all this fintech disruption hype for real, or is it just an interesting news story that doesn't have a lot of impact regarding how the financial markets operate, or maybe more importantly, how financial services companies themselves compete? So before we jump in, I want to introduce our panelists. And our format's going to be each of the panelists is going to spend 4 or 5 minutes just giving an opening comment, their sort of perspective on fintech disruption. And then we're going to go into what will hopefully be a relatively free-flowing conversation about the nature of the impacts, how different types of companies are responding, and really what's behind all that. So let me introduce our panelists. To my immediate left is Phillip Rees, former president of American Express's Consumer Card Group, and deep experience in payments and marketing in the credit card business. And very interestingly, spent the last decade or so as a fintech investor, and he is involved in a couple of pretty high-profile companies, including Betterment and Zopa, and has a lot of experience both on the corporate side as well as on the fintech startup side. And then in the middle, Mona Vernon from Thomson Reuters. Mona is part of the Thomson Reuters Innovation Lab. Lots of work on the question of both the analytical question of how do you take data and turn it into revenue and business streams, and a lot of work on the business side. Okay, that's an interesting analytical question. What's involved in building partnerships? What's involved in the technology side of that? What's involved in actually making that happen? And then on my far left is Ben Golub from BlackRock. And as some of you may know, Ben's one of the original 8 founders of BlackRock back in the day. And as he likes to joke, BlackRock is what happens to a startup if they're really successful. And not only today he sort of operates as chief risk officer there, and with a really interesting perspective on all the issues regarding fintech as it impacts a big company, but also he's part of the core group driving their investment in Future Advisor, one of the other robo firms that competes with Betterment. And so with no further ado, what I'd like to do is turn it over to Phillip, let him sort of share some opening comments. We'll then go to Mona and then to Ben, and then we'll kick it around for the time that we have.
Bob, thank you. So I have spent probably the last 15 years investing in stuff, in only 2 domains more recently, in fintech and in data analytics, nothing else. Every time I went outside of that scope, it was like a black hole attacking my wallet. So this is what I do, and therefore I'd better believe that the so-called fintech revolution is A, real, and B, works. The question that was posed to me is, what do I think are the mega trends right now? I think you've spent all of today talking about some of the more obvious mega trends, Bitcoin, more regulation, more regulation, more regulation, and maybe even the stupidity of some executives in the fintech market who have done damage to many of the companies in fintech. So I'll talk about some of the things that I think are coming down the pike, and let me, that I'm interested in right now, that are, I think are interesting challenges and will change the nature of the marketplace. And let me just go through 5. There are actually many. The first one is attacking the problem of lazy money. So in this room, there is probably, I don't know how many people, but there's probably something like $10 million of assets sitting earning 0 interest in the banks right now. In the banks, in financial markets, in portfolios. That is lazy money. Maybe not in this room, but in the United States, 30% of the people who have lazy money in the banks are paying interest on a loan somewhere that is not mortgage. That is not mortgage. And the question is, why is that? And why, in a world of data and analytics, of automated cars, can we not find a way to automatically move money around, to optimize it for the individual consumer? Why should banks be sitting on all this free money which belongs to you and invest it not on your behalf, but on their behalf to other people? So there are very interesting companies that are addressing this problem right now. 0 latency. Why is it that you can go, if you're a small merchant or a large merchant, and somebody uses a credit card in your business, it takes you 3 days to get cash from Visa, MasterCard, American Express, Discover, etc. How long does it take to send a wire, an international wire out? How long does it take to make an ACH payment? Why is there any latency in the payment market at all? And there are, by the way, in India, this doesn't exist. But in the United States, nothing has changed. Interesting companies attacking latency. We should be in a 0 latency environment. Destacking. What is destacking? In today's world, if you want to start a fintech company, you should have 3 people and a dog and never anything else. You can rent your license, you can rent your tech team, you can rent your customer service team, you can rent your analytics team, you can rent everything that you need to make a business work. And the question is, who are the companies that are going to assist in that destacking? Because that is a trend that will change the nature of fintech, because almost anybody with an idea can get in with 0 friction. Just-in-time insurance, bad slide, bad slide. I have to work on my PowerPoint capability. You know, I mean, particularly after going after Roberto, that was challenge number 1, but this is pathetic. So just-in-time insurance. Why should you have your car insured? So I happen to have a vintage car which I drive 12 miles every year, because that's about all it can take. Why do I not only pay for 12 miles of insurance? I should pay for the fact that it could be stolen. But for the rest, why can't we use GPS, information, data, analytics to invoke insurance, not on an annual basis, but when you need it? Very interesting companies attacking this problem, worth investing in. And finally, the unbanked. If you went outside of the United States, if you go to Asia, if you go to Africa, the banking systems that have been developed in those areas could work massively for the unbanked here in the United States. 40 to 60 million people don't use the banking system in the United States, and on a transaction basis, they pay more than you or I or anybody in this room, and that can be served. So why don't I invest? Because I look for companies that are massively disruptive. Massively disruptive are financial institutions? No. I look for massive disruption of consumer expectations. At the end of the day, only one thing counts when you're investing, and that is what are the customer expectations. And if you can disrupt customer expectations, if you can get the result that happens when the first time you used Uber, you said, whoa, look at this, and you told everybody your marketing costs of your financial service is 0. You don't have to advertise. Word of mouth does it. This is the necessary condition, but not necessarily the sufficient condition. So what are the sufficient conditions? Sufficient conditions really are 3. Can you ensure the margin on average and over time? And that depends on technology, analytics, not data. I didn't change this in real time based on what Roberto said. The stack, which is, can you outsource a lot of what you need to do? And then, can you secure distribution? The next thing you have to have is the law. Do you have a compliant environment? Because the regulators are bad today. There may be some here, and if you are in this room, you probably regulate some of my companies, and I apologize right now. But it is becoming harder and harder and harder. And then the most important thing is the will. Management is, at the end of the day, the most critical thing to look for, because no company, other than maybe BlackRock, gets flawlessly off the ground and grows into a successful company. It is tough. It is really tough. And if you can find the right management with the right margin, with the right legal structure, disrupting the customer, then in fact you have a future. So with that, let me stop. That's my introduction.
Excellent. Thank you.
And it's over to you.
Great, thank you. This is great because I get to build on some of the things this morning, and Roberto, and your points, Phillip. So I think that hopefully this is going to be interesting. So I look at a lot of startups in the fintech space and meet with a lot of them. I sit on the board of the Fintech Sandbox, so we actually worked on one of these things that we felt was really needed, which was to make access to data easy and painless to drive higher experimentation and try to kind of accelerate all these interesting things that could happen. And I could talk about a lot of the trends, but I'm going to focus on this one. Roberta called it organic data. We call it data exhaust. And I wanted to sort of pause here and talk about basically this idea that we're on the verge of a whole set of business model changes. So just quickly a little bit about me. This slide is actually a little out of date. I run Thomson Reuters Labs. Our first one was sitting right next to MIT, where I thought I could find a few good people to hire. And then we're now next to the largest computer science school in Waterloo. We are in London, in Zurich, London, Cape Town, because some of the trends you talked about, I think, are critical in driving fintech. And of course, the one that's not here but is coming up is Singapore, where I actually think there's a tremendous amount of really cool activity happening with the support of the government. So, I wanted to put this glossary really quickly just so that we sort of anchor ourselves in the sort of things we're talking about. Raw data, I think, is between raw data and data exhaust, which Roberta calls organic data. I think we're sitting on a set of really interesting ways of seeing new business models, but also sort of underpinning that claim that every company is a data company and that there are a tremendous amount of business models that emerge from a confluence of sort of key elements. So one is this rise of data. The second is networks, all these networks that connect everything. And then the stuff that you're seeing beyond the data sets are really what we call the rise of the machine. So when you bring those three trends together, which Eric Brynjolfsson at Sloan talks about, and I was lucky to be one of his students, you start seeing a potential for a lot of really interesting things. So what I wanted to just share with you is, all these things are happening because of this abundance of data, because of the exponential compute and the network. And I sort of think about this as sort of an opportunity to think about 3 types of business model. And what's exciting is that there are many, many ways to contribute to the rise of these business models. And so I have this little model. I had to build a framework. I'm trained as an engineer. I wasn't sure if I could do this right, so I went in and pitched it at HBS and at their digital summit to see if someone could kick it and take it apart and refine it a little bit, but it kind of stands, and I just wanted to, now that it survived HBS, share it with you guys. But it's sort of this idea that, look, you can be in the business of selling the data. You can be in the business of providing that data to do a lot of interesting things. Sometimes that data is actually in your system, so it runs into your business operations, and if you do some interesting things with it, you do analytics, then you start building better business operations. Perhaps you build new services. Instead of selling engines, you can rent the engine, and we'll start seeing increasingly new data-enhanced products and services out there. And then what's really interesting is we're starting to see the rise of these data platforms. And the idea that I wanted to put out there is that as you see this rise of all this raw data, this organic data, there's also this idea that there are consumers that are interested in that data sets. And today, I think to some extent, there is some matches that are happening, but I think there is potentially a tremendous amount of innovation that can happen to connect the two sides. And what I figured is, okay, so this is pretty abstract. It's a framework, right? Let me give you an example. And this is one that's, I think, an idea that became real. So there was a gentleman in Boston who happened to have a funny background. He had a maritime studies expertise and happened to be a lawyer. So what he did is he managed to negotiate an exclusive right to a set of container-level ship data, okay? Because he was a lawyer and he happened to know about all this stuff. And the first thing he did is, and this is where I think the excitement is going to come, is that he manually tried to figure out how to monetize these data sets. So he came and tried to sell it to data providers like Thomson Reuters. But then by doing the analytics and understanding the value of the data, by joining it and doing all the dirty work of the data janitorial, he figured out that data is extremely powerful and it's worth to be sold to one person, itself pivoted into a hedge fund, okay? So in this case, the not organic data set or the data exhaust found one consumer because it was really, really powerful to sell it to this one person. And maybe you could go to a BlackRock and say, you're the primary customer. One of the things that's going to be really exciting as all these data sets are going to come up is, I think, and this is so relevant to Sloan and the brilliant people that are at Sloan, is that there might be a mechanism to innovate around the economics of information to try to figure out how to price this, to signal and identify the right way of distribute it. And so I think that as you start solving and designing frameworks for privacy, as you make providers of this data comfortable, you might see a world where you start creating these entirely new data marketplaces. So it's just an idea to share, and hopefully that gives a few people ideas of where they could actually plug in. And I'll just say that there's a lot of startups that are building a ton of technology that sort of support this new world.
That's great. Thank you, Mona. Ben.
Go.
So when I got the invitation to speak on this panel, I wasn't sure whether it was I was the right speaker. First of all, anytime you're on an MIT panel, it's really intimidating. But in this case, while I had been involved in starting 3 arguably fintech-type companies over the years, one being BlackRock, one being BlackRock Solutions, and then a little company called TREP, that's not been my current gig. Which is to try to keep a fairly large company from getting itself in trouble, which keeps me pretty busy. But when this panel was beyond the startup, I said, well, I think I can speak a little bit to that because it just so happens that about a year ago, BlackRock bought a Silicon Valley startup. And yes, they have a dog, and I'm told they even have a little pet pig that runs around their offices. They had joined as part of BlackRock, and how we deal with that in the transition might be of some interest. And the company in question, it happens to be a digital advisor. It's called Future Advisor. And I'm going to guess most people know roughly what this digital advisor, robo-advisor type of organizations are, but there's certainly been quite a bit of growth in them. A whole bunch of them have propagated in the past couple of years. Some have actually accumulated a noticeable amount of assets. Others seem to be struggling to get any kind of liftoff. And these companies, in some respect, have a similar model where you interact as a retail customer with the machine, and you specify something about yourself, and then they offer some kind of automatic rebalancing mechanism, risk-adjusted, age-adjusted for who you are. And the algorithms can differ, but they're all doing sort of a life path type of framework where there's a glide path, and they manage that. And some of them will do tax loss harvesting and things of that sort. But what's interesting is that we're now entering an age where the mode of investing and interacting with that screen is becoming something which people actually consider do. There's a great TV commercial. I don't remember which firm it is. They show some, a man is having a dinner with his, mid-20s son, and the father's proud of the son, and he says, I should introduce you to my broker. And the son says, why? My interest in finance grew from my father, and I'm sure that if I told my father and suggested to him to do it on a screen, of course he would look at me like I was crazy. So the question, what do people think about this? And in terms of the conditions of liftoff, I guess to your point, is there demand? And it's interesting when you actually look at why people seem to want to deal with digital advice. Number one is convenience. Number two is simpler. So unfortunately for some of the MIT finance guys, it's nothing about efficient, optimal algorithms, things of that sort. Then there's like no one's pushing products at me. So again, I'm looking here on the list and I don't see mean variance optimization or all sorts of things that we spent many years of our lives trying to do well. What are the opportunities in this space? It seems like there's the ability to access a certain genre of people and perhaps more people and let them interact at a lower price point. You can have an increased engagement with them. You can interact with them if you're sort of into that type of communication, sending out blast emails and things of that sort. It becomes a natural form of interaction. You can also have potentially a broad range of products over time, and you can leverage what would seem like infinite scalability. Once you build the mechanisms, you would think you could scale it up, and just like there are a billion some odd people on Facebook, you're dreaming of betterment to have the billions of customers. Well, hasn't played out that way so far, and there are a lot of challenges to it. One of them is the fact that there's this thing called regulation. And, if there's anyone in the audience who's a regulator, we love you. We love you because you make this a difficult game to play. And, as regulation increases, we went through a phase at my firm where we would complain the regulations making us do this, the regulations doing that. And one of our board meetings, they pretty much said, guys, shut up, suck it up, and deal with it, because this is part of your business. This is what you do. It's not a distraction from what you do. So you better be very, very good at it. So now the attitude is, if it's like making us cringe and it's making us suffer, we just imagine how it's crushing our competitors who don't have the scale that we have per se. So this regulatory quagmire, it's an interesting thing. If you kind of hang out with the Silicon Valley guys and you have that kind of, let's do it, let's change the code tomorrow, let's, iterate. Well, welcome to the world of regulated industry. You can't do that. And you can't do certain things that you used to do. So the regulation, to some extent, is a competitive barrier. Now, the regulation they're also there for a reason. So It's not as if this is some sort of irrational barrier, because as we know, people do all sorts of nasty things when you're dealing with abstract financial products, because people give you money today and you give them something tomorrow, assuming you're there. That's the nature of finance. So we need to regulate. There are challenges. At some point, people are going to start to, I was making the comment before that we didn't see on the list, what about the algorithm? Well, at some point, people are going to raise the question, what about performance? Okay, who's good and who's bad? So you may have a great front end on robo-advisor A, and you may have a clunky one on robo-advisor B, but one of them may actually outperform by the other one because they're actually doing things better. Hopefully those are the MIT alumni who are putting that education to work. There are also then challenges of data protection. So I'll tell you, when we acquired this company, I sent some of the technology risk people to check out the place, and the guy came back and his comment was, I said, well, what do you think of how are these guys set up? He said, well, I had an account there, but as soon as I came back to the office, I shut it down. And trying to make those kinds of adaptations. So in the case of specifically, what was our first challenge was, how do we match and maintain this Silicon Valley magical culture that we thought we paid a whole lot of money to acquire. And that means we had to let them have the animals run around the place, and free food, and which we never have at BlackRock, unfortunately. Hoping that's one of the things we can learn from the startups. So keeping the people, keeping the culture, getting them to adjust to what the world of regulation looks like, because strategically, Future Advisor had made a important decision prior to its acquisition, which was they decided that being in the direct-to-consumer business was a losing proposition. Like I said, that's what B2C. Instead, they said, we want to be B2C, because the cost of acquiring a customer relative to the low fees you get, it's actually, you lose money in every customer, you're not going to make it up on volume. And the way we know the arithmetic, the cost of acquisition in this business, if you're in B2C, is uneconomic, and it's just a question of time before people fall away. So we had to say, okay, we're going to go B2B2C. It means that we're going to take a product and have it white labeled to a financial institution, and who already has thousands, if not hundreds of thousands of customers, and we're going to provide them with the technology so that they can already make this available to their client base, but not have to go through finding the people, going through the thing, doing the account setup, things of that sort. It's not a surprise that who are the leaders today? Vanguard, because Vanguard's got probably millions of customers, and they're just able to transition some. So our business strategy is to try to provide a technology to those folks. In terms of what do we have to change, we had to actually teach them, if you're going to be providing products to a financial institutional market, it's very different. Typically, a lot of fintech companies think that they can basically provide the service on their terms, and the customers will adapt to it. But when you're dealing with regulated financial institutions, guess what? You have to provide things to specifications that they will feel comfortable plugging into. And a lot of the work that we did with them was, since we do this through our BlackRock Solutions business already, interact and install complex software into financial institutions, we sort of showed them how we do that. And so far so good. We've been able to line up a whole bunch of institutions which have either just turned the knob on or about to turn the knob on and do this thing. So it's an experiment. How it plays out, we'll see. Is it going to be the startups that grow? Is Betterment going to come and take over the world? One of the things you talk about is, what about the tech giants? If Amazon or Google or Apple decides to do this, will they be able to crush the incumbent financial players? There's a company called WeChat in China. I saw a demonstration at a BlackRock strategic conference where one of our analysts came up with her iPhone. She said, "I'm going to buy a mutual fund," and via WeChat, and she had asked answer one or two questions. You know, do you like a lot of risk or little risk? Okay. Then she just bought it right there on the phone, and they have like hundreds of millions of customers already. So we don't know. So they could be winners. And then finally, the financial incumbents. You know, whether it be the BlackRocks of the world, the Charles Schwabs, you know, who have those huge existing customer bases, will be the winner. We will find out. Thank you.
Great.
Thanks.
Thank you, Ben. So with Phillip, Mona, and Ben, what we're going to do is maybe a little bit of a lightning round regarding some of the issues that are out there, and get the perspectives of each of them regarding the impact of fintech and how it's really sort of playing out. You know, pick up on Phillip, your concept of the disruption of customer expectations, right? And we have wonderful examples in fintech disruption of sometimes it's disrupting the cost of a service, like what Square's done to credit card acceptance. We have the same thing going on with Robo. We have how processes have been simplified a lot, customer expectation side. From each of your perspectives, what do you see as the biggest sort of crater or zone of impact that fintech is delivering on the financial services industry? And why don't you go first, Phillip?
Sorry, you were moving.
Mona was ready.
No, go for it.
So I think that it really depends on what domain of fintech you're talking about. So in payments, as I talked about before, it's got to do with things like latency, ease, reach, etc. I mean, if you're doing a person-to-person payment, and for example, some of the banks recently have limited their person-to-person payments so that you can only do it to somebody else who's inside the bank. So then you use Venmo. Venmo is an interesting service, but it's not as prolific as it could be. So there you're worried about things like speed, ease, reach, ubiquity. If you talk about things like lending, the average small business looking for a loan in the United States, going back 2 years, took 59 days to get a loan approved. You can go to On Deck and you can get a loan approved right now in something like 24 hours. That is a significant difference. You can go to their data questions. So if you want to, I'll keep in small business for a moment just as an example. The average small business loan at a bank requires 3 years of tax returns, a significant amount of bank statements, your personal financial performance, etc. And each bank and each financial services company has got its own format for that data. So you cannot shop for a loan if you're a small business, because it takes you 3 days to fill out one set of forms. And if you want a comparison shop, you have to go somewhere else. So you get companies today that are consolidators that you fill in one form for them. They shop your data. They shop your data to everybody, filling in the formats for every provider. And that allows you to get convenience, speed, bidding of price of loan and size of loan. So there are all these things that some combination of technology, data, speed, ubiquity, all help.
Yeah, I mean, I think I would add that, if you just focus on the data space, there is, and I think some of it was covered this morning, but I think there is just some things that are the combination of not just technology, but culture that produce scale. And sometimes I see companies that say, oh, I'm going to build my big data stack, and get me to Hadoop and all those things. What they forget is the way, and I know I can do an Amazon or, but the thing that's sort of embedded in the way the big giant techs do things is not just the technology, it's the culture of being able to have sort of that data science fluency across the management. I mean, Jeff Bezos goes to his internal machine learning, meetups, and it'd be interesting to see how many CEOs of financial services know the tech guys who do machine learning in their company by name.
Yeah.
So I think there's sort of this element of speed that comes. Often people think it's the technology that brings it, but it's actually the organizational processes. And I think agile can happen within a regulatory environment. You might not be able to release it to customer at every iteration, but perhaps you can find a way to more rapidly get feedback with one friendly customer who becomes your partner in the development. And we've actually seen in our company a rapid change of getting products out to lawyers who, of all people, you wouldn't think are part of an agile sprint, but have actually realized that the robots are their friends and are increasingly interested in seeing this. So I know this is not an easy answer, but we often underplay the management and the people.
So Ben, to you, based on Mona's point, that it's less about technology and it's more about culture, and the big differences in culture that allow the disruption events to be occurring. With Future Advisor and BlackRock, maybe talk a little bit about the culture issue and how the challenge that represents to the incumbents, if you will.
Well, I mean, we were given instructions that leave these guys alone. I mean, BlackRock culturally is very much, what's our informal corporate slogan? It's called One BlackRock, meaning we don't have silos. That's the four-letter word that destroys your career if you're a silo person. So we try to rationalize processes. We Aladinize everything. We put them on the common platform. So and we've done many mergers of investment managers where we did that, and we don't you don't even know who came from Merrill Lynch and who came from BGI, things like that. So because people work together. So when we came to the Future Advisor, this was whoa. We're actually going to leave these people alone. We're going to let them do what they want, dress what they want, follow their own policies, and limit contact. And leave them in their own space, let them have their free food. But what's been very interesting, and we were very much concerned that we could sort of lose all the people, lose all the energy. In fact, the actual personnel turnover is dramatically lower than BlackRock regular, and certainly relative to Silicon Valley. That somehow or another, and partially I think is a good leadership from the people who run that business. It has been successful. What has happened as we've gotten to know each other and trust has been built up, we're finding that they're now coming to us and say, hey, could you help us with X, Y, and Z? So maybe it's a little bit like if you kind of have a teenager that if you push them to do things, they're going to do the opposite and they're going to rebel. But we've had, it's been a good collaboration by having respect and bringing their leadership and demonstrating to them that even though we're kind of like, big and old, we can still rock and roll, we can change, and we've adapted some of our practices, learning from them, and I think they see that as mutual respect.
Great. How about the area of impact? So if you look across the different categories, where there's fintech activities, fintech businesses, robo payments, P2P, so forth, where would you point to as the best or the biggest area of impact on a pre-existing business model or a pre-existing way of doing business as a result of all the different areas of fintech activity? The biggest area of impact that you can point to. Mona, we'll let you go first.
Realized, you mean? Or?
Yeah, realized. Yeah. Like today versus 3 years ago, this business has changed because of this.
I mean, I wished I could say cloud as realized, but I don't think we can still say that really. But I think the combination of it's hard to say realized because I think there's some of these things that are not happening, but I think there is tremendous amount of progress made in joining data, pulling data together, putting some of this stuff on the cloud that is starting to feel like it's getting easier. And I think we're going to start seeing the impact of that both on the cost-saving side for the large institution, but more interestingly on the kind of innovation that could come up.
Right.
It might be still a little early.
Okay. Phillip.
Well, you know, I think there have been fintech revolutions through time, and even in my time. But let me maybe jump on something recent. One of the companies up on that list is called China Rapid Finance, and China Rapid Finance is one of the larger P2P, whatever that means, lending companies in China. It now makes 500,000 loans a month. So how do you make 500,000 loans a month in China where there are no credit bureaus available to the P2P businesses? There are credit bureaus available to the banks, but they are not what are called thick files. They don't have a lot of data inside them because lending has not been a long-term play. So what you do is you go along to Tencent, you know, Alibaba, Tencent, two big players, and you say to Tencent, well, you've got a lot of data. You've got a lot of data, and perhaps we can partner up and we can look, and it's back to Roberto's discussion before, and we can look at transaction data and what you're doing on Tencent and what you're buying and how often you're gambling and whether you're buying sex and whether you're doing this or that or the other. And we can use that and build a credit algorithm based on your purchasing data. And that's what we do. And then based on that, we start offering a loan, and the initial size of the loan can be as small as $100 over 6 months. And after people have paid back 3 payments, you now have an index of responsibility, which you then add back to all the other data, and you start increasing the loans. So things like this, which is, I think, an interesting model of how to use data where data is not traditionally available, how to usurp the banks because the banks are going to use the credit bureau and that's all they're going to use, how to make interesting partnerships, and how to be creative, and it's back to your point, I believe, and that is the CEO of that company is one of the great analytic players that I have ever met in my life. He was the guy who was number 3 in the Chinese master's exam and was sent. If you're number 3, you are hot. Let me tell you, you know what you're doing. He was number 3, and he was sent by the Chinese government to get his PhD here in the United States, and is really a very, very competent guy who would see the opportunity in the data and the ability to analyze and how to build a business model. And it's it is a profitable company. Every loan is, not every loan, every cohort group is profitable, because in lending, every loan should not be profitable. And it's a terrific example of radical change based on data in an environment where otherwise people couldn't be borrowing money.
Ben, same as your area of impact, but I'm going to lead you a little bit, going back to regulation. There's a lot being talked about regarding the Department of Labor fiduciary rule coming in implementation next spring, and how that's going to dramatically impact and accelerate the growth of robo as a lot of the traditional advisors back away. So robo could end up being one of the biggest areas of impact a year from now. What's your view of the intersection there of the opportunity that regulation is actually providing the robo space?
I mean, in the grand scheme of things, the robo sector is minute. So we think that the DOL has huge implications for the asset management business as a whole, and there might be some residual benefits that fall onto robo. I mean, for people not familiar, the Department of Labor has mandated that if you're going to be providing investment advice to a retirement account, you have to act as a fiduciary. And that means that you have to put the interests of the client ahead of yourself. Now, that's actually in this country considered revolutionary. I mean, yeah, believe it or not, that's revolutionary. But the implications are that how people who have direct interactions with clients will make decisions will change. So there'll be much more sensitivity of fees. There'll be much more increase in the use of index-type products. There could be more activity flowing into a robo-advisor if that's the right form of interactions. We do think it has a profound impact on the industry, and we'll end up with asset management fees falling, and the burden of being an asset manager will be higher because you have to have some alpha to distinguish yourself to merit the fees. As of today, most of the robo-advisors tend to work in index products, so that's less of an issue. It could create some more pressure, I suppose, on the pricing of index funds, index ETFs, but those prices are pretty competitive already.
Right. We're going to run out of time here in a minute, but I'm a big baseball fan, so I want to use a baseball metaphor to ask the last question. And last night I went to bed, and it was the top of the ninth at Fenway Park, and the Yankees were ahead 5-2. And I went to bed, and I was so totally discouraged when I went to bed last night because I'm from Boston. And then I was on the taxi in from LaGuardia this morning, and I was getting text messages from some of my friends swearing at me over the success of the Red Sox. And I was like, what are they talking about? And I had to read after the fact that in the bottom of the ninth, the Red Sox scored, 5 runs with 2 outs and won the game 7-5.
This is a dreadful way to end this panel.
That's right.
I've been enjoying it up till now.
That's right. So using the metaphor of a 9-inning game where everything can change in the bottom of the ninth, using the metaphor of a 9-inning game in this whole disruption process we're going through, so what inning are we in? Is it like, are we halfway through the game? Is it like just the very beginning? Is all the things that are easy to take care of, like payments and interchange and the cost of advice, and there's nothing left to do? Start with you, Ben. How far in this process of fintech disruption are we into? First inning, ninth inning?
I would say the second inning, but I'm not sure that the game ends at 9.
Yeah. Excellent. Mona?
I think we're really early on, right? So, I don't think we've realized the combined power of network, abundance of data, and the rise of the machine. I think we have seen just the beginning of this. It's going to be a really exciting time. And to just say the regulation piece in the US, because I have a global team, there are some unbelievable things happening elsewhere. Just look at the UK with the observatory put together by the regulators to try to help things like crowdfunding. So, and mentioning WeChat. So, this is about to be. I think the S curve we haven't quite got there yet.
Early.
Yeah, I think this is a season. And there are companies that will lose the game, but they might win the season. So frankly, not that I can, but I would invest in Lending Club. Maybe nobody else in the room would, but I would invest in Lending Club. And there's some companies on Ben's chart of winners. There's some companies on Ben's chart of winners that I wouldn't touch with a 10-foot barge pole. And that's the beauty of this marketplace, that there will be some supporters and there will be others that are detractors, and you never know who wins. PayPal was a company on its deathbed until eBay decided that they needed to find an alternative way to get their merchants to be paid. Where are we now? So who knows?
Excellent. Let's thank Phillip and Mona and Ben.
Thank you.